Welcome back. Today we're talking to Head of Macro and Risk at Morphic Global Opportunities Fund, Jeff Wood. Welcome, Jeff. So Jeff, tell me, you are the Risk Manager at Morphic Global Opportunities Fund. So you're less concerned with what you invest in than what you don't invest in, is that correct or not?
Yeah, my title is the Head of Risk and Macro. And what we're trying to do is mitigate both losses and also losses that occur when things don't go as we planned.
So to what extent do you get involved in the actual implementation of investment strategy?
Well, risk management is a key part of the Morphic process. It's involved in the idea generation, the portfolio construction, how much capital we'll assign to certain ideas, how we scale into our investments, how we pull out, and also we use a lot of macro oversight in terms of how do we hedge the whole portfolio.
Well, Jeff, how were global markets and Morphic's performance in August?
August saw a change of trend. For most of the year we've been in sideways, choppy price action for most global markets, where we saw a decisive move down. Global markets were down 6% in US dollar terms. For Morphic investors, the continued fall in the Australian dollar offset some of those losses, and we were down around about 3.5%, which is immaterially better than the benchmark.
So it's really in line with the market?
That's right.
Which is good performance given markets were so volatile. Yeah. What's causing these markets to sell off, Jeff?
Well, I think what we've got is global markets are reappraising the global growth view at the moment. The term that's used in the bond market is the idea of a new normal, which is that as we come out of the recession that the GFC caused, we're going to move to a period of lower potential growth, and this is impacting equities in that we're wondering what rate can markets grow at as we go forward. The key reason for this is that when you come out of a recession that's damaged household and bank balance sheets so materially, it takes a lot longer for economies to heal. And at the same time, we've had a 7-year period of gross underinvestment in capital.
So would you expect interest rates to stay lower for longer in that environment?
That's what the bond market's pricing, and we'd agree with that. So the question is, does the equity market also include those views when it forecasts the earnings growth for the companies?
And how do you react to those weakening conditions?
Well, it was a very testing month for us, August. One of our risk management policies is as a stock falls more than a certain percentage, we'll stop that position out. So as the month moved on, we progressively built our cash holding, which got up to around about 30% at its peak. So the gains we made from hedging and holding cash into a falling market essentially offset the losses we made on some of our high momentum stocks that fell more than the market.
And looking forward, what's the outlook?
At the moment, we believe this is a correction inside a bull market rather than the start of a bear market. We believe it can go lower. We're still holding a material amount of cash at the moment, should it continue to do so. The price action has been such that the bulls that have controlled the market really since 2011 don't seem to be coming in very forcefully. More medium term, we're very excited by some of the opportunities that are being made available in certain sectors as markets sell off, but for now it's very much wait and see and continue to hold some cash.
So risk averse first?
That's right.
Jeff, thanks a lot for your time today. We'll look forward to seeing you again in the future.
Thank you.